Don't believe us? Listen to the market pundits from Shankar Sharma to Ravi Dharmeshi to Madhu Kela, who are talking about the next wave of wealth creation from startups, from the new age companies. And my next guest is one of them. He became, or rather his startup became a unicorn during the pandemic year of 2020. In the pandemic lockdown, Zerodha added nearly 2 million accounts. It has a 15% market share. Nikhil Kamath, the co-founder, joining me live right here on Startup Central. Nikhil, thanks so much for agreeing to do this interview. You and I had been in touch for the last few days saying, let's get Zerodha on the show the day the Sensex scales 50,000. That day is finally here. It's the fastest 5,000 points also that we've seen being added in the Sensex's history. I want to begin by asking you, this is a peak that has been scaled also thanks to retail investors. We often talk about how there is poor retail participation, that it's usually the institutional investors that control everything. But what's exciting this time around now is that because of technology and democratization, thanks to technology, you're seeing retail participation soar like never before.
Hi, Nayantara. Can you hear me?
Loud and clear.
Okay, super. Even though the retail participation has soared as a portion of the total population, it's still really low in India. I think this trend is changing with a favorable tax policy wherein retail pays only 10% on LTCG if they hold equity for longer than 12 months, along with a flattening interest rate curve, which has been on the decline for a certain amount of time now. A lot more people are coming into the stock markets. I think one of the big differences in this rally is in my time spent in the markets, for the first time, I think retail has come in after a correction. A lot of people have come into the markets through the 8,000 to 10,000 Nifty kind of level. And a lot of them are seeing significant gains today. So I hope this sets a benchmark for things to come. And a lot more people, a lot more of the retail population in India uses the stock markets as a means to allocate their assets and their savings.
So Nikhil, tell me something. When I were to look at the digitization push, which has become a reality thanks to the COVID-19 lockdown, you've added 2 million accounts. We've all been hearing about how the retail participation is increasing and nowhere is it where it should be. I take that point. But have you ever analyzed the data that, the new retail investors that are entering, or at least on the Zerodha platform, what age group? Are they coming primarily from the bigger cities or the smaller cities? Are there more women that are entering the stock markets?
Sure. So primarily from the bigger cities, average age for the new people coming on is about 30. Average ticket size is about 80,000 rupees. If you were to break down the demographics to male and female, I would say about 16 to 20% is female. And hopefully this number does go up.
Okay, so average transaction 80,000. It's still coming in from the big cities. Women's participation is going up, nowhere where it should be. But Nikhil, I also want to understand a little bit from you on and focus a bit more on the retail participation. Now, historically, it's always said that when jab retail investors aa jate, it's time for the institutional investors to exit. Paise bana liye, exit. But that is also this time round because, it's always seen that the entry of the retail investors marks the entry of the bear run that's going to begin.
Yeah, I think the domestic institutions have been selling for a while. We see a lot of foreign institutions pumping in money. I mean, the FI numbers have been obscene, especially over the last 2 or 3 months. But domestically, institutions seem to be liquidating, booking profits. I think cognizant to the fact that, we're at a 40 multiple today, probably at, if not the highest point, one of the highest valuations the equity markets are getting today relative to our own country's past and our stock market's past. it would be prudent to kind of exercise some amount of caution. We recommend that to people coming in, but generally, as a investor who's entering equity markets today, you have to realize that you're buying it at a valuation which is much higher than our historical average. So we recommend people diversify, enter great quality companies, and try and do it with as little leverage as possible.
But the markets, for someone who's wanting to make an entry, feeling left out, FOMO, as we call it, it is going to be historically the most expensive entry point, right? Because just the way the market valuations are. It's a totally different debate whether the markets are divorced from on-ground reality. I don't want to get into that. It is expensive for an entry point. You're talking about how you caution those on your platform. Can you elaborate a bit on that? What retail investors need to keep in mind particularly?
Yeah, I think 3 or 4 rules which generally go a long way. They're not the most complicated of things to do. I think stick to large cap companies. When it comes to compliance and governance, you have a fair degree of certainty that these companies are relatively better than the others. Stay away from penny stocks, stay away from small cap companies. Diversify, not just sector-wise, but also company and asset class-wise. I think to have a component of fixed income in your portfolio with very little or zero underlying risk is very important as well. And don't probably rush in to catch the rally, which a large part might be over already, but be a bit more systematic about it. Maybe if you have to invest 10, start with 1 or 2 today, and every quarter you can add 1 to your portfolio. Stock market is cyclical. It goes up, it goes down. Just because it is rallying today does not mean there will not be opportunities to enter at better value tomorrow. Be patient, wait for those corrections, wait for those dips, which invariably come by, and add more allocation when that happens.
Right. Can you explain to our viewers the role that technology has played in getting the retail investors to participate during the pandemic year? Was it a case of where, people were at home, they were on the screens, there was just so much information out there, there were certainly opportunities now where you didn't need a broker, you could do it directly, you could get access to information being given on platforms like yours, and they felt that they can try with a little bit of money, and then, the markets are going up, so it might have helped.
All of the reasons you mentioned, I think the fact that people had a lot more time at hand played a huge part in it. And also with uncertainty over their primary income, I think a lot of people started to think that, an ancillary income, which might aid the total income of the household, will go a long way. Also time, a lot of people didn't have time to actually open an account, start learning and start investing, but now they had that time as well. I think more than all of these factors, a big portion of our country always put money in a bank FD, and they were able to get maybe 7%, 6%, sometimes as high as 8%. With the interest rate cycle pointing downwards, today a bank will give you 4 or 5%. And I think with inflation generally nudging above the 4% target rate, which the RBI has, people do not see the sense in leaving money in a bank as much as they have historically. So I think a lot of that capital is coming into the equity markets too. And a lot of this seems to be coming directly versus having, a fund manager or advisor in between.
Nikhil, I want to ask you another question, which is that, what we've also seen, for example, in 2020 was the NASDAQ, taking one example, do phenomenally well. Look at Tesla, look at the share price of the other tech giants, Netflix this week. There have been products and online tech platforms that have been coming out, talking about how Indians can also participate in on Wall Street, be a part of that rally. Is it something that has really taken off? It's obviously going to be very small, I understand that, but those opportunities, and that's something that Zerodha is looking at all?
I wouldn't say so much as Zerodha, but I think the appetite for equity globally is going up. A lot more people in India want to have some exposure to equity in the West, especially since, the NASDAQ and the companies in there, the FANG stocks, have been all over the news for a long time now, and they have returned extremely high returns in this time frame. There are a couple of funds which are derivatives of indexes there, which are available to the Indian public. And we see a lot of people using the LRS gateway to, take some money into America and invest in companies there. I think the problem, Nayantara, is very little of the innovative startups we have seen in India have come into the public markets here. They have chosen up until now to raise a lot of the capital through private equity firms or funds from across the world, but not so much locally from the Indian population. They've not really come into the retail ecosystem. You can take a Flipkart or a Swiggy or a Ola or a Oyo. All of these guys have raised capital privately. I think something needs to be done here. The retail participants of our country, the citizens, should definitely have the first opportunity to be able to invest in this. And I think the onus lies with the government to make it a little bit more seamless for companies to IPO and go to the public markets to raise capital.
Nikhil, in fact, isn't that the big ask from Finance Minister Nirmala Sitharaman on 1st February during the budget, for the union budget? It's something the government has spoken about even during the Atmanirbhar package, the direct listing, and you've had the likes of Mr. Sanjeev Bikhchandani of India Info Edge now talking about flipping, companies changing their domicile just to give exits. All of that, it is a big problem. And at the same time, this is the exciting space. This is the future, the tech companies, the innovation that we're seeing, founders building for India and for the world. Is that going to be the next pocket of wealth creation for India?
Well, I hope it is. And I hope, people like the retail investor actually gets to play a part or be part of the innovation that is happening locally here in India. I do hope that happens. As far as the budget is concerned, I think it has been built up to be, the budget of the decade, and it will have huge structural systemic changes. I mean, everybody has a wish list. I think what we are wishing as an industry would be for STT to be rationalized to a large extent. I think we've been asking for this for like a decade now. I think removing that impact cost from transactions will help a lot more people come into the markets, and it will make the markets a bit more robust compared to our international peers. So fingers crossed, hopefully that happens this time as well.
I'll make this my final question because we have to take a commercial break as well, Nikhil. I did want to talk to you a little bit about the valuations, but we've touched upon that. But since it's budget season, your wish list for the finance minister?
Well, I would say STT rationalized on equity transactions. The second thing would be, personally, I think the government needs a mechanism to get a lot more capital. So a wealth tax or an inheritance tax like it is prevalent in, say, the US, UK, or many Southeast Asian countries as well, I think will go a long way in bringing down the income inequality in the country. Even though that sounds a bit counterintuitive, I think a wealth or an inheritance tax will be good for India in the long run. I think income inequality is a huge problem today, but it is set to grow and become a bigger problem going ahead. We have like minute wants and asks in the asset management industry, for example. I think pass-through taxation in a category 3 alternative investment fund, for example, will help an instrument which is attracting a lot of foreign capital to come into the Indian equity ecosystem directly. So many things on the wish list, but I think these three would be on top of the list.
You haven't asked anything, you don't have any wish list for the largest startup community?
Well, I think if inheritance tax were to come in, and if, well, without taking names, imagine, say, the wealthiest 5 people in our country, after their time, if they had to give away, say, 10-20% to begin with as income tax to the government, I think it will give the government significant ammunition to aid the largest strata of our ecosystem in society. I think at the end of the day, we all expect the government to do so much, but one has to wonder where they get this capital to actually be able to help a population as large as India comes from.
I don't know if that's going to make you very unpopular, coming on live television, mooting an inheritance tax at a time when large industrialists have gone in for forming trusts and setting up family offices. But I've got to say, Nikhil, I appreciate you being so candid with your views. Thanks so much for joining us on this edition of Startup Central and for giving us the interview on the day the Sensex scaled 50,000. Incidentally, we're going to get Nikhil Kamath back very soon on Startup Central to talk about his other business, which is a hedge fund, Trubicon, which is giving a 40% return. When have you ever heard of that kind of a return from a hedge fund? But that will be for another day. Thanks a lot again. We'll take a short commercial break, but stay tuned. A lot more coming up on the other side. What's the future of big tech under the new president, Joe Biden? That's just one of the things that we're going to be discussing after this break.